Hey everyone, welcome to another episode of AdMail. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hi everybody, and welcome to another episode of AdMail. On today's episode, Prohibited Transaction edition number 5. Today's podcast will generally address questions involving prohibited transactions and the checkbook control self-directed IRA structure. So before I get started tackling these 3 questions, I just wanted to briefly give everyone an overview of what the prohibited transaction rules are and what the self-directed IRA LLC structure is. So essentially, when IRAs were created in 1974, the IRS didn't say what you can invest in, only what you cannot invest in. And there's generally 3 things you can't invest in. That's it. If you have an IRA, life insurance, collectibles like art, and then thirdly, and more broadly, any transaction that in any way, directly or indirectly, personally benefits you, your lineal descendants, your parents, your children, your spouse, daughter-in-law, son-in-law, or any entity controlled 50% or more by such persons. So in other words, in order to have a prohibited transaction under 4975 of the tax code, you need to have an IRA or retirement account. And on the other side, you need to have a disqualified person. Okay. And if you don't have one of those 2, then you're not going to have a prohibited transaction. So now that we understand what those rules are, what is the self-directed IRA LLC? So the self-directed IRA LLC is essentially a solution that takes advantage of the power of a limited liability company, which gives you flow-through tax treatment. So it's an invisible entity from a tax standpoint, but it also gives you limited liability protection from creditors and tax on your assets. So what limited liability protection does is it protects your assets outside of your LLC, right? So we all know if you are doing investments involving, some risk, and real estate is generally a very popular investment for IRA investors. And a lot of those investors like to use the LLC as an extra layer of protection. And on top of that, it gives you a layer of privacy, right? Because the investments are not made in the name of your IRA, but they're made in the name of the LLC. So you get a bit of a level of, camouflage / privacy. So that being said, let's get right into the questions, which I think will better explain, some of these checkbook control prohibited transaction scenarios. So first question from Stuart H. And Stuart wants to know, I have a checkbook control IRA LLC that you guys set up. Can I use the IRA funds to fly to Mexico to check out a property for my IRA to buy? So believe it or not, I get this question quite often. And listen, my instinct is always like, don't push it. Why? Because you're the manager of the LLC. And we know the Swanson case in 1996 was the first case that established the rules that you can manage an entity wholly owned by your retirement account without triggering a prohibited transaction. And then there's Treasury regulations under 4975-6, which basically says as a manager, you can do what's reasonably necessary, right? You can hire a lawyer, accountant, you could buy the real estate, do the economics of the deal. You shouldn't do anything else. My concern with flying to Mexico is go prove to the IRS that it's not a vacation, right? It's one thing that you're driving around the block to check out a new house, but you wouldn't write off the gas and have your IRA pay for it, right? So I think these are one of these things, Stuart, that you're just going to have to go on your own dime. Don't take a deduction for it either way. Check out the asset, go on vacation, enjoy Mexico. And if you like it, have your IRA buy it. But writing off that cost to your IRA, first of all, it doesn't make tax sense because you're using IRA or Roth IRA assets that are not subject to taxation, that could grow based off compounded returns, and then you're using them to pay for an expense. It actually is not a tax-wise decision, and I think it's super risky because then it opens the door potentially to an IRS to attack you and put the onus on you as the taxpayer to prove that you are not getting any personal benefit. So Stuart, I would say don't do it. Second question of today's podcast from Sylvia W. Sylvia wants to know, I'm the manager of my self-directed IRA LLC. can I hire my brother to serve as manager and pay him? So Sylvia, yeah, technically you can. And I think I've done a similar question a couple weeks ago. But I wanted to repeat a form of this question because I do get it quite often. So technically a sibling is not a disqualified person. So a sibling's like me, right? You can pay me to do a service. I just would say make it reasonable. I wouldn't pay if your IRA has 200 grand in it. I don't think I'd pay your brother 50 grand to manage your LLC, an apartment that, the renter just sends you a rent check every month. Not a lot of activity. So I'd be smart about it. I'd think about, first of all, why do you want to pay your brother? Remember, you're using tax deferred or tax-free funds for an expense, just like I mentioned to Stuart in the previous question. You want to be very, very tight with your IRA money and use it only for investment purposes and not be frivolous with it for expenses. So if you have to pay your brother because he's providing a real service, then do it. Hopefully it's a fair and reasonable and good price for your IRA. But yes, Sylvia, technically you can do it because your brother is not disqualified. Third and final question of today's podcast from Jasmine T. And Jasmine wants to know, I own 25% of a business that does real estate management. Can that company provide real estate services to my self-directed IRA? So this is probably the best question of the day, and I think the toughest question to answer. And I'm going to preface it with the way lawyers like to answer questions. It's great, right? Don't you hate that you're paying someone like a lawyer or an accountant to give you a tax answer, some tax advice, and they kind of stay in the middle and give you both sides. I hate that. I work with an attorney who is very smart, but every time I ask him a question, I get the statute returned to me. I'm like, okay, I can read the statute and Google it. Like, that doesn't help me. I need you to explain it to me and give you your opinion, which some lawyers don't like to do. So let's dissect it, right? Okay, you own less than 50% of the entity. So the entity is probably not prohibited. Good, right? Now, anytime an entity that you have some involvement in, even if it's 5%, 1%, 10%, under 50%, anytime it transacts directly with your IRA, there's always a level of risk. I'm not saying it's a high level of risk, but you are always opening the windows ajar, open for the IRS to potentially walk into that window or sneak into that window. Obviously, if it's 45, 49%, the window's opened a little bit wider. If it's 1%, 2%, more narrow. 25%, I don't know, right? It's based off facts and circumstances. I'll give you a case that I usually cite to, Rollins v. Commissioner, 2004 tax court case. In that case, Rollins, he was an accountant. He owned less than 50% of a bunch of companies. The companies needed money, which was the important fact that the tax court focused on. Rollins took his 401k, lent some money to those companies. The companies paid the loans back. Everything was great. It was a good investment for his 401k. The company's got the money. Somehow he gets audited, and the IRS says you did a prohibited transaction. Rollins says, what are you talking about? I own less than 50%. I'm good. Here's the tax code. And then what the tax court said is, well, there's sections under 4975 C1 D, E, and F, which is basically a broad catch-all self-dealing conflict of interest type provisions. And what they said is, you didn't prove that you didn't personally benefit. So the onus is on you as the taxpayer to prove to the court that, or the IRS, that you made an IRA investment to 100% exclusively benefit the IRA. Rollins wasn't able to show otherwise because he, I guess, indirectly or directly benefited because those companies needed the money and got the money. Now, if he was able to show that, JP Morgan or Morgan Stanley was going to lend the money too, then maybe he wins. So in this case, if you can show that, hey, my salary is the same, whether this company provides a service or not, I'm not getting a bonus, there's no indirect benefit, it's a small deal, we have hundreds of real estate clients, this is one client, it's not going to move the needle revenue-wise, profit-wise, it's just a service, you're probably good. But, if you need this deal, like to secure your position or your employment or your bonus, or if the management service company doesn't get this deal, it loses its operational ability to continue to function and have to close its doors. Those are all the facts and circumstances that you'd have to be aware of. But what I want to kind of end with and just say, Jasmine, just be careful. It's a gray area. Anytime an entity you have some ownership in, obviously under 50%. Once you're over 50%, you're dead. So you're dead in the water. So you can't even go there. But under 50%, just in the back of your head, remember the Rollins case. Probably okay. You want to make sure you have good facts and circumstances. And I always tell my clients, listen, before you do this, just think about this. Assume the IRS will knock on your door, which they don't, but they'll send you a letter. And just assume they will contest this. And how confident do you feel that you have the proper facts and supporting arguments to show that you did not personally benefit from this arrangement? If you feel super good about it, you're not involved in signing the paperwork, you have nothing to do with this, you're one of 50 employees, doesn't change your life, you're good. If this is very important and will change your personal, financial position or employment position, then don't do it, because it's probably self-dealing or conflict of interest. So again, these are the kind of things that IRA Financial, we have expertise in. We've seen it all. We've done hundreds and hundreds of thousands of investments for clients with billions and billions of assets. So I think we're probably the best position to help clients, navigate these rules. And the rules aren't that complex, but it's important to understand them, understand their implications, understand how the IRS thinks. And I think we're better at that than really everyone else in the space. So great questions. My favorite podcast. I love doing it. Why? Because we get to learn from each other. I have great questions in queue, but don't be shy. If you have questions, send them in. You can email them to info@IRA Financial. Just say AdMail, Ask Adam. You could leave a question on our social media platforms. Of course, our amazing YouTube channel, Instagram, X, LinkedIn, Facebook. You can find us and just say, hey, I got a question, and just submit it. Or you can leave a comment on our podcasts and videos, and they'll get to me, I promise. And I'm always looking for good questions, because not only do I find them challenging and fun, but we all learn from them. And that's really the name of the game. That's how we're all going to become better, more successful, and more wiser / richer self-directed investment. So thank you for hanging out with me today. Hope you enjoyed today's podcast. I know I did. Have a great day. I'll see everyone again next week. Thanks.